Hello, my name is Dave Wright. I'm the AVP of Loan Origination here at the Hudson Valley Credit Union. I work with the mortgage loan originators here in the Hudson Valley. And we're very excited to introduce Randy Dillow. He's the Senior Regional Director at National Care Credit. And Randy, I'd like to turn it over to you at this point.
Well, thank you so much for that introduction. I'm really excited to speak with you all today, even if it is virtually. I wanted to go over some ins and outs of credit and what it really means to you as a prospective borrower, but really what it means to us just as consumers in general. I currently am the regional director, senior regional director, if we're being honest, of pretty much the Eastern Seaboard, but I focus predominantly on these states of New York, Virginia, Maryland, and Georgia. Been with the company a little over 5 years now. I've supported Hudson Valley that entire time, but actually my company has supported Hudson Valley for almost 10 years now. So we have a very good, long-standing working relationship. But really, I take this business very personally. I want to make sure everybody kind of understands who I am and why it's so important to me. So a little bit about my background. Before coming to National Credit Care, and I won't get into the full long story, but before coming over, I used to own health clubs here in Colorado. I was a personal trainer for many years before owning those clubs, and my passion was really about helping people. It wasn't just about weight loss or the journey. It was taking a client that wanted to buy a specific truck, and I can tell you this story. I can remember the client to this day, and he was just too large to buy the truck he wanted to buy because he knew he wouldn't be able to get in and out of it. And to take him from that journey to the point where I got him to where he could purchase that truck was so rewarding and amazing for me that my passion really became about helping people. When it came time to sell my gyms, market conditions were right, and I sold the 3 health clubs I had here in town. I really needed to find my next calling and my next passion. And going back to that clutch of I really just want to help people. How can I do that, but still be in a sales type industry? And so when I found National Credit Care, it was just such a blessing for me because I'm now taking clients, especially those that have maybe gone out and found their dream home or have been working with a realtor over some time and not able to get that finalized deal because their credit's not quite right, and being turned down from that dream purchase and taking them from that lowest point all the way to the closing table is just like taking those personal training clients on their journeys. So it's very rewarding to me, and I just want to make sure that comes across, since this is over Zoom, that I do take this very personal, and I want to make sure that I'm working with each and every one of you individuals in a proper way that shows you compassion and shows you what we can do for you. A little bit about the company and kind of why we exist. About 15 years ago, the Federal Trade Commission did a report that determined that 80% of all credit reports contained some sort of detrimental errors. That equated at that time to 40 million errors on credit reports. And what's crazy about that is, these are literally the keys to the castle. That 3-digit number is so important, not just for the home purchase, but this affects things like we'll get into later, your car insurance, your interest rates, obviously. Everything is dictated by that number. And the Federal Trade Commission took a huge black eye by seeing that number of 80% of errors, 40 million of them. So what they decided to do was combat it with a federal act called the Fair Credit Reporting Act. The Fair Credit Reporting Act is a beautiful tool. What it allows for every consumer to challenge things on a credit report through an agency like mine. The FCRA states that every item on a credit report has to be 100% complete, accurate, and verifiable by law. So that's great. They have a nice act that says everything has to be right, but how is it going to be enforced? There's no penalties for violating the act. In fact, there's no agency that really can enforce it. And so that's where National Credit Care came in. We're actually licensed by all 3 bureaus, as well as the Attorney General in all 50 states. What the licensing allows me to do is enforce that federal act. So I'm able to do an investigation and verification process on any and every item on a credit report. Even if it is yours or is accurate, that doesn't mean that they've dotted every I and crossed every T, or more importantly, can verify it through proof of record. So what I do is I launch these investigations on every derogatory account or item, looking for erroneous information and trying to get this removed from your credit permanently. In doing that, we've averaged about 20 points per month of increased credit scores and around 4 deletions of negative and erroneous information across all 3 bureaus. We've done that for 15 straight years. That's been our average. We've had some spikes where we've actually averaged a little higher, like the beginnings of COVID, really helped us. And even today, we're still seeing some lingering effects of people working from home. not being able to get to the records we're requesting, and therefore losing these investigations. So that's kind of the basis of who National Credit Care is and what I am supporting for you guys. Let's move on to how scores are formed. I think this is very important because none of this is taught in the education system. You could take Econ 101, you could take Econ 301. It's never taught what makes up a credit score. So I just want to kind of go over these with you. First and foremost, I want you to understand FICO is a term used to certify algorithms. So when people like us go look at our own credit score on Credit Karma, Equifax.com, True Credit, I mean, I could name a million, Credit Sesame. When we go look at those scores, that is a FICO score. However, it's not a lending score. And that's what's really important to understand. When it comes to FICO, there's actually 54 algorithms out there that are approved for FICO. However, there are only 3 that are approved for lending. And what those 3 are, as I know them, Fair Isaac version 2, Classic 04, and Beacon 5.0, or as the layperson knows them as TransUnion, Equifax, and Experian. So those are the 3 algorithms. But when we get a credit report, if you've ever looked at your credit, you'll notice, why are there always 3 different scores? Like, why aren't they just all the same? If my credit is my credit, why are they different? It really breaks down to 2 pieces. Algorithms, there's small differences between those 3, but more importantly, what's called contracts. So the credit bureaus themselves, all they are is an information warehouse. They store scores, they report information that's given to them. They have no dog in the fight. All they do is report what's given to them. But the way it's given to them is through contracts. So every bank, every creditor has a contract with TransUnion, Experian, or Equifax, or all 3. When they report the information, they pay the credit bureau to do that. So when they report a late payment, or they report an on-time payment, or a charge-off, or a collection, they choose which bureaus they report to. So not all the time do things always get reported to all 3 bureaus. Maybe certain banks only report to 1 or 2, but it is their purview, and that's why you'll see some deltas. Now, another reason you see this is you have positive contracts and you have negative contracts. Positive are mortgages, credit cards, car payments, student loans, the normal things. These are, I like to joke, they're the narcs on credit. They tell on everything. They're going to tell when you pay on time, when you don't pay on time, what your limits are, what your balances are. They tell every bit of info. So all of that info is reported to the bureaus of their choice. But then you have these lovely things called negative contracts. And what negative contracts are, I like to go back to my gym reference of owning a health club. You know, I charged monthly dues of about $180 a month to be a member in my gym. It was a pretty nice upscale club. But if I had members that stopped paying their dues, maybe they had their card stolen and they didn't update it with me and they weren't coming in anymore, I had about a 3-month window where I would try to collect those past due dues. I would call them, we would have some texting systems and things of that nature, trying to get a new card on file. At the end of 90 days though, I was able to now turn that over to a collection agency if I chose to. I could sell it to them. So let's just assume they owed me $400. I could take that $400, I could sell it to a collection agency for about 50 to 60 cents on the dollar, make a little bit of my money back, and now the collection agency owns the debt and they are going to continue to do everything they need to do. Those are the types of instances, cell phones, gas bills, electric bills, gym memberships, where you can pay on time every single month for years and it never affects your credit positively, but it only affects it negatively if something goes completely south. So that's why you see these differences in all of those scores. It's just those contracts and then those little differences in the algorithms. You can see the final bullet on there. I just like to go over this. It's an acronym. It's MARIO. What are the 5 industries that use credit scoring as risk analysis? So there's 5 industries out there that will use credit information to determine risk. It's going to be MARIO: mortgage, auto, revolving, insurance, and then online or other. So let me just cover the online or other. That's essentially like a Credit Karma. They use it to give you a consumer score, but in hopes of getting you to click on their ads and their offers in order to get paid. So that's the other industry that's out there, or like we call it online. But those are going to be those 5 industries that actually use that credit score to form some type of risk to see if they want to loan you money. All right, moving on. What actually makes up the scores? So I told you there's some minor differences in the algorithms, but if essentially I took all 3 of them and compressed them into one pie chart, this is really what it would look like. We have obviously the biggest piece of the pie you can see there is negative items and payments. That's 35% of our score. So this is where everything lies. This is your on-time payments, your late payments, your charge-offs, your collections, your bankruptcies, anything and everything only affects 35% of your score. While it's the biggest piece, it's not the only piece that I'm able to help clients with. It's definitely the work, the hardest work that I do in those investigations and all of that information I send out. However, that would leave 65% of the math that I'm not manipulating if I just focus there. So we like to break down every area. And the next biggest one you can see there is debt utilization. This is really important to understand for credit because this is the easiest and quickest way to manipulate your own credit score. What this is only credit card utilization. This has nothing to do with your loan balances, your mortgages, your cars, your student loans. None of that applies. The only thing that applies here is the utilization of your actual credit cards. Now, this area being 30%, it's a very large piece. So if you don't have credit cards, that's problem one. You're actually missing 30% of your credit score. It'd be like walking into your college finals, getting 100% of the questions right and getting a 70% on the exam. That's the same way if you do not have a credit card. So the first step I would do in a consultation with a client is determine what they have for positive credit, like these, and then coach them into products that are going to help them get this piece of their credit score if they don't have it. The second flip side of that coin is for the most of us that have credit cards, how do we maximize our points? We maximize them by keeping our balances below 10% used. For example, if I have a $1,000 limit credit card, I would ideally like to keep my balance at all times below $100. That would then maximize my points on that credit account, giving me all 30% of my points available to me. If I have 3 credit cards, and I have them equally at about 10% used, then they're actually equally weighted. 3 cards, 30% of the score. That means each one is worth 10%. Even if one's a $25,000 limit and one is $500 limit, it doesn't matter. They count equally the same, and it only factors in that utilization number. You still get positive points between 10% used and 30% used. At the point you go above 30%, though, you start losing points off your credit score. So one of the first steps when working with a new client is to determine this utilization and give them a plan of which cards to pay down to what amounts in what order. We want to maximize every point possible to try to get you to that closing table. And this is a quick way of clients being able to manipulate their own scores. All right, so moving on, we have length of credit history. Now this is, most people would think not something that can be manipulated. However, there are a couple tricks that I have up my sleeve for this. Your goal here for this 15% piece of your score is to have 25 years length of history. It's very hard to achieve though, because length is about average length of open accounts. That means if you have a 21-year-old mortgage and a 1-year-old car payment, you do not have 21 years of credit history. You actually have 22, those 2 accounts combined, divided by 2 accounts, and you end up with 11 years. So every time you refinance a car, you refinance your house, they close that account and open a brand new one, therefore cutting severely into your length. This is the one area where every credit expert out there, you've always heard, don't close old credit cards. This is why. Has nothing to do with your balances or utilization. They're telling you that because they don't want to see you lose your length. Mortgages will come and go, car payments will come and go, student loans by some grace of God get paid off. When that happens, those go away. But the credit card, especially the oldest credit card in your wallet, becomes the most important tool that you have because you can keep it open in perpetuity. It never will close if you use it properly and keep it active by utilizing the card every month or so. So that's why it's so important in that area. But how can we manipulate it? So there's a couple tricks, some old school lending tricks. Number one would be what's called an authorized user. I would have you reach out maybe to your mom or your dad or your grandma, grandpa. Maybe they have a really old credit card. Hopefully they have some good old credit. And you can add yourself as an author, or they can add you as an authorized user to that account. And when they do that, the beauty of credit is it copies the entire trade line. It takes the payment history, it takes the length, it takes the utilization, it just copies the whole thing directly onto your credit. But there's no backlash. So if your credit's low, it wouldn't affect your parents or your grandparents' credit. It also will, you're not responsible for the card. So assuming maybe something goes really bad later and the bill stops getting paid, you can always pull yourself off of it because you're not actually a co-debtor. But it's a nice way to manipulate this area of credit scoring in order to boost some length. Some other examples are common nowadays. Student loans. If you go all the way back to maybe your freshman year student loan and it's been in deferment for 5, 6, 7 years, you can actually take it out of deferment yourself, make one payment on it, and now you would inherit 5, 6 years of credit history because it's now active again. So there definitely are some ways I can help manipulate areas if we need to find 5 to 10 points to get a loan done. Moving on, new credit. This one's interesting. It's the only place in the algorithm where we start with all of our points and we can only lose them. What I mean by that is if you have not had an inquiry or opened a new account in the last 12 months, you physically have all of these points available, 10% of your overall ceiling. The way you lose them is just like I said, an inquiry on your credit. So anytime a bank, a lender, car dealerships, anytime your credit is pulled for a hard inquiry, you will lose 2 to 5 points off your credit score for about 6 to 12 months. After that, if you open a new account, they will deplete this area of your score as much as possible for around 6 months because they want to see how you operate that new credit. If I go open a Discover card for $50,000 today, they don't want me to then run down to American Express and open one for $50,000 there. They want to see how I use it. And the only way they can hopefully try to control that is by showing that I've depleted this area of my scoring. And then I get to show them how I'm going to operate the card. Maybe I pay it in full every month. Maybe I run it up and make minimum payments. I mean, there's so many ways that you can use that. They want to make sure they get their money. So the only way to dock you is in this area of new credit. Final piece of the pie. This is the only one I can't manipulate, but we're going to go back to that same acronym, Mario. To have a perfect 850 credit score, you have to have perfect payment history, perfect utilization, 25 years average length, no new credit in the last 12 months. And then this last piece, Mario, again, you have to have a mortgage, an auto loan, a revolving account, an installment loan that is not an auto or a mortgage, like a student loan. And then you have to have what's called other. Now, other most traditionally is going to be for people with really great credit that have the green American Express charge card. That is not a credit card. What it means is if I put $10,000 on my Amex, at the end of the month, I owe $10,000. There is no minimum payment. It is not a credit card. It is a charge card. Therefore, it reports on our credit report as other. So as you can tell, all these pieces crunched together, it is next to impossible. And in all years I've done this, never have seen an 850 credit score. But now you'll maybe understand why there's so many moving parts to that credit score. And that's why it's so hard to get ahead. All right, let's move on to what I can take off of a credit report. Really, this is an all-inclusive list. As you can see here, this is pretty much every negative type of item you may have on your credit report. However, I would definitely say there's a sliding scale of ease to hard when it comes to these removals. So let's talk easy. Any medical debt is very easy. Medical collections run rampant on credit reports nowadays. Most people don't even know that they have them because they've never even been contacted. And therefore, because they're bought so readily and they're so cheaply purchased, they're very simple to beat when it comes to my investigations. The second piece, and probably the most important thing I want you to take away from this class, is the fact that when you pay a collection, that does not help your credit. So if you have the unfortunate circumstance of a collection going on your credit, say it's from Sprint, the bill was supposed to be paid off, it wasn't paid off, and they've turned it over to collection. Maybe it's $50. Unfortunately, at that point, the dollar amount no longer applies. So you could have a $50 collection or you could have a $500 million collection. It doesn't affect your score any different. All that matters is what's called date of last activity. So if you pay a collection, the shady underbelly of their systems are they do not delete it. What they do is they make it $0, but they actually refresh the thing that matters, the date, to the date that you paid it. So now you have a $0 collection that's brand new and therefore didn't help your credit at all. In fact, could have lowered it if it was an old collection. So the good news is if you've already done that and you need the help of removing it before it just goes away on its own after 7 years, it does become one of the easier things for me to remove. Paid collections, there's not much fight in them anymore. They don't care because they already got their money. So therefore it becomes a little easier to remove. So those are kind of the easy level. Then we get into the slightly harder stuff where we're going to talk about collections that haven't been paid yet. Those are a little bit tougher because now there's money involved, although easier than a charge off because they're still with a third party. They don't belong to the bank anymore. They were sold. Like when I said I sold people's dues to collections, same thing. Now that it's with a third party, their records are not as good. So when we start investigating them, they may not have things we request. Therefore, it's a little easier to beat those. Also, late payments that are older than a year, those become a lot easier because now you're talking about digging through old records, financial statements from the bank. It becomes harder for them to find those things. So therefore, they become a little easier. Then we get into the hard stuff. Now we're talking bankruptcies, charge-offs, which would be like a repossession of a car, a credit card maybe you had where you ran it up and didn't pay the bill and now they've charged it off. Those are still all very removable, just like foreclosures, but they are much tougher and take a little bit more time than the normal, easier things to remove. Good news is everything on a credit report is workable and is removable, but there's definitely, like I said, that ease to hard difficulty scale. All right, moving on. This probably all sounds like magic. I like to pull the veil back and show everybody exactly how I do it. I could tell you this because it can't be duplicated. And the reason why is the volume that we send out. I have around 400,000 active clients right now. We send out just over 10,000 investigation letters a day. That's 50,000 pieces of mail a week that are going on behalf of our clients. And that's why we win. We basically publish so much information to the creditor, it becomes overwhelming and very hard to answer. And the beautiful thing is you see there, step 3 or number 3 is a 30-day time frame. I don't care that it's hard. They have 30 calendar days to reply. If they cannot or do not reply back to the Bureau with what we have asked for, the item is permanently removed from your credit. And then the final step on there is that economic decision. I basically force collection agencies and banks to really step back and look at, is it worth it to continue fighting national credit care knowing I don't stop going at them? Is that worth the money that's still there? Or should that money be spent elsewhere, like Susie in accounting, doing her actual accounting job, but not digging for records that I keep requesting? So really, that's kind of the breakdown of how we go after these items on a credit report. All right, guys, I hope you enjoyed this class. I know this was the down and dirty of credit. I didn't want to take too much of your time, but I do appreciate you listening. And if you do have any other questions, please get with Hudson Valley and make sure you reach out to me so we can talk. Thanks so much.